Okay, folks. I I did hear from so on the final exam, I did hear from some of you about the multiple choice and you're being concerned about partial credit. I'll work on making it more of a regular exam rather than a multiple choice. So I'll have to work through exactly how to do it because setting in attachments won't work because 225 attachments come through. It's going to be crazy. So I'll have to figure out a way in which you can have the regular exam online and not do it multiple choice. But let me work on that. But for the moment, if you have to make plans to fly out on, May 8th, May 9th instead of May 12th, go ahead and do it because there will be an online exam, one way or the other. Whether it's, regular or multiple choice, we'll work through. But so make your plans based on that assumption. Your second quiz is on Monday, so make sure that yeah. Go ahead. That's a good question. If it's going to be online, it has to be that same time window because how do you control the process, right? You take the exam, I know there's an honor code, but you take it at different times in the same day. It's very difficult to control the fact that the exam will already be out there. So if you cannot take it at that time, let me know. I will figure out a way to give you a different exam in the earlier week. So logistically, if you cannot take it between 11:15 and 1:15 on Monday, April 12th, which is I'm sorry, May 12th, which is the actual scheduled time, I need to know so I can figure out a different exam to give you on a different day. It can be online as well, but it'll be a different exam and be the earlier week. Okay. So we'll figure out the logistics of it one way or the other. We'll get that nailed down. So second quiz is next Monday. The third quiz is 2 weeks after that. The second quiz will cover everything in packet one after what we did for the first quiz, where we ended with betas and cost of equity. So we'll pick up with cost of debt, go through the rest, primarily investment returns. What you did on the case is pretty much what the second quiz is going to be all about. Of course, in less detail. I can't ask you a big question like that, but pieces of it might show up. Are there any other logistical administrative questions? Your final project is due on the last day of class, which is May 5th, which is the Monday. So if you haven't even met as a group, it might be time to at least get that process going so that that people in the group are pulling their weight, getting the companies done, or at least starting to work on it. So today we're going to talk about the financing mix, but today we're going to talk about it in less abstract form than we did last session. Last session, we talked about the trade-off on debt with the equity. So Ravi, remind me again, what are the two biggest benefits of borrowing money? What's the biggest two advantages? You don't have to give up equity is not a good reason, right? I mean, but that's a controlled reason. It's got nothing to do with reducing the cost of capital, but that can be one of the secondary reasons companies don't want to go out and borrow money. So we talked about transitory reasons, psychological reasons, but a financial reason, not giving up a share of ownership, especially if it's a publicly traded company, it's not your company anyway, shouldn't be a factor. Leon, what are the two biggest benefits? Tax benefits because interest expenses are tax deductible. And I did mention that there are variations across the world. There's one part of the world where debt does not give you a tax advantage. That's in much of the Middle East. For religious reasons, debt is not encouraged, so interest is not taxed. It's a one part of the world where it's not true. There's another part of the world where there is actually a tax advantage for equity as well. It's a very strange setup. In Brazil, when you raise equity, you're allowed to claim a tax deduction called interest on capital, which means you can take your book equity and multiply by rate that the Brazilian government gives for that year. So it's 11%. 11% of book equity you can claim as a tax deduction. It was created so that you could offset the tax benefits of debt. But in much of the world, debt gives you a tax advantage. In some parts of the world, there is a limit on how much you can have in interest expenses. including the US. The US 2017 tax code, in addition to bringing the marginal tax rate down, interest expenses could not exceed 30% of EBITDA. If they did, you wouldn't get the tax saving anyway. So it reduces the tax benefit, but it's still a tax advantage. The second, of course, it can make some companies more disciplined in the way they pick projects. What kinds of companies? Mature companies, lots of cash flows, with a disconnect between management and ownership. If it's your own money, this would never matter, right? Because you'd manage it well. But if it's other people's money, there's this worry of, hey, people might be sloppy, borrowing money might make you more disciplined. Two big advantages. Okay. Derek, what are the costs of borrowing money? What do you trade the benefits off against? Risk of bankruptcy, right? No matter who you are as a company, when you borrow money, you increase the likelihood that you might not be able to make that debt payment. Maybe from 0.01% to 0.03%. That's a probability of bankruptcy. And you multiply it by the cost of going bankrupt, which is two components. One is the actual cost of bankruptcy, the legal cost that sucks up so much of your resources. And the other is the indirect cost, which is people perceive you to be in trouble, you are in trouble. Okay. It's a bankruptcy cost. Wade, what's this, what other costs would you add to the mix in addition to bankruptcy costs? You're an equity investor. No, Kelly's a lender. You're an equity. Agency cost. So tell me again what agency cost is. What is it, and why is it a problem when you borrow money? I'll get you started. You're an equity investor. Kelly's a lender. Do you both have the same, very different interests, right? Kelly, because she's a lender, cares about safety. You are an equity investor. You want upside. So what does Kelly do when she lends you money? Covenants restricts you from doing things. And for some companies, if you're a regulated utility, say, I don't care. But if you're a technology company or pharmaceutical company, you say, I don't want that person looking over my shoulder telling me what to do. I need to be able to spend 60 billion in AI if I feel like it. Agency costs. And so if you're a company that values flexibility, for God's sakes, don't go out and borrow money, then complain about the fact that the banker keeps looking over your shoulder. It's exactly what you should expect. And a related cost is the loss of future flexibility, which is if you borrow money today, you can't borrow it later when you might actually need it. So it's good to preserve some debt capacity for a future day. That's a trade-off. And we looked at a very special case of that trade-off. That Twilight Zone episode where I put in a world with no taxes, no default risk, and no agency problems. And the result there was you can do whatever you want. You can borrow 10%, 30%, 50%. That's a Miller-Modigliani theorem where it doesn't matter what you borrow. It's a very special case. The world is not a Miller-Modigliani world. You can borrow too much. You can borrow too little. And today we're going to talk about how to actually find that right mix. We ended the class with that financing hierarchy. Remember that if you were given a choice as a company and you're a manager, you value control and you value flexibility. So given a choice, you'd rather fund everything with retained earnings because nobody's asking you questions. The minute you go outside the company to borrow money or to raise equity, it comes with a catch. Now you've got to explain what you're going to do, and you don't want to do that. And you give up some control, you give up some flexibility. But in terms of the hierarchy, retained earnings is on top, straight debt. The conventional debt is second, and then you get convertible debt, preferred stock, and at the very bottom of the list, I said, is convertible preferred stock. So I ended the class by saying, if you have a prospect or a tombstone where you see what a company is using, you can at least guess what kind of financial health the company has. And here's an example. This is just a couple of years ago, just before Bed Bath & Beyond kind of closed its doors and declared bankruptcy. It declared that it was making a convertible preferred stock and warrant offering. Why, when you get so deep in the hole, are convertibles and warrants actually going to become more attractive? What's the only thing you have to offer the world? We're a risky company. And the only security that benefits from risk is options. So not surprisingly, you're going to see a lot of options and convertible bonds because that's the only way you can raise money. But that's not a good sign when you see a company do that. So what I'd like to do today actually is to put some more specifics, because right now, if you look at your company, you can make a judgment. Can my company borrow a lot or not very much? But if I said, how much is a lot of debt? Is it 20%, 30? We don't have an answer to that. So today I want to talk about what that mix of debt and equity is for your company. Or put differently, you can look at your existing debt ratio. Is this the right debt ratio for my company? I'm going to take you through 5 different approaches. We're going to spend most of our time on the first approach because it kind of lays the foundations for the other. I'm going to go back to an instrument we've already used in this class to make other judgments, the cost of capital. It was a hurdle rate when we did investment analysis. But I'm going to use it in a different context here. I'm going to use it as an optimizing tool. I'm going to argue that through the cost of capital, I'll be able to find a mix of debt and equity that's right for you as a company. The problem with that basic cost of capital approach is I'll make some implicit or explicit assumptions that you might not be comfortable with as to what happens to the rest of the company as I borrow more money. The second approach, I will take the cost of capital approach and introduce some constraints so you feel a little more comfortable saying, okay, now I feel okay going with the cost of capital. The third approach is called the adjusted present value approach. It was developed at the University of Chicago probably 40 years ago. And if you run into a University of Chicago MBA, they'll talk about this being the only way to optimize debt. I'm going to talk about how to do it right and why in practice it's done in a half-assed way and leads to some very bad decisions on debt. The fourth approach, and I firmly believe that this is actually the approach that most companies use, they pay lip service to cost of capital or adjusted present value. But if you caught them in an honest moment, say, why is your debt ratio 30%? You know what the answer is going to be? Because everybody else in our sector is at 30%. We'll talk about the draw of being where everybody else. I call this the Me Tooism disease in corporate finance, okay? The peer group approach. And finally, we already talked about the life cycle approach. Very low tech, but very effective. Tell me where you are in the corporate life cycle. I'll guess what kind of debt ratio you should have. So let's get the cost of capital approach going, and let's review how we got cost of capital. We shouldn't really need to because we just left it behind when we did investment analysis. The cost of capital is a weighted average of your cost of equity and your cost of debt, right? The cost of debt is adjusted for the tax benefit. There's where the tax benefit of debt shows up. So as you look at the cost of capital, you have a cost of capital, the existing debt ratio, and you can compute that cost of capital. I did that for Disney, 7.81%. 88% equity, 12% debt. The question we're asking is, if I change the debt ratio, could I change my cost of capital? Seems obvious it should, right? As I go from 12% debt to 20% debt to 30% debt, will my cost of capital change? So Franz, help me out here. If I go from 12% debt to 20% debt, tell me the good thing that happens to my cost of capital. What might cause my cost of capital to decrease? But even before that, cost of equity is higher than the cost of debt, right? Even without tax benefits, you can say, hey, my cost of capital is going to go down. Of course, if you add the tax benefit effect, the effect is even greater. Debt is cheaper than equity. I'm replacing more expensive financing with cheaper debt. Constantine, what's the side effect of doing that? As I go from 12% debt to 20% debt, what should happen to my cost of equity? And what instrument in my cost of equity is causing my cost of equity to go up? There's a risk-free rate, there's a beta, there's an equity risk premium, right? The risk-free rate and the equity risk premium have nothing to do with your company, so the only thing you have left is the beta. And here you can see why the way we've talked about beta helps us at this stage. We don't get it from a regression. We get an unlevered beta based on the businesses you're in. We put in a debt to equity ratio. Now with a 20% debt to equity ratio, debt to capital ratio, I have a higher debt to equity. I'll have a higher levered beta and a higher cost of equity. So my cost of equity will go up. If I increase my debt from 12 to 20%, that's almost doubling my debt. And you're the banker. Remember the cost of debt you had at 12% based on a single A rating or an A plus rating? Will that cost of debt be affected? So think like a lender. Now I'm doubling my debt. Will you lend me money at the old rate? You shouldn't, right? I'm a riskier company. You're going to increase your cost of debt because you see more default risk, so the cost of debt will also go up. Now, do you see what the dynamic is? You're replacing more expensive equity with cheaper debt, but both the cost of equity and the cost of debt go up. And what you effectively will end up with is a different cost of capital. Whether it's lower or higher will depend on whether the trade off works in your favor. And as you do this, as you increase debt, there's one more thing to keep your eye on. You increase debt, your interest expenses go up, right? And to claim the tax benefit and interest expenses, what has to be true? Your operating income has to be higher than the interest expense. So there'll be a tipping point where the interest expense will actually blow through your operating income and you start to lose the tax benefits as well. So even the tax benefit might be affected. So the whole process goes into play. Now, I am always amazed when CFOs say borrowing money lowers your cost of capital, right? No, it might not. It depends on where you are in this process. So the cost of capital will change as your debt ratio changes. It could go down, it could go up. And say, how does this connect to an optimal mix of debt and equity? Let me remind you again that the objective in corporate finance is to maximize the value of your business, right? That was the original objective. I'm going to use cost of capital in a third way. Cost of capital is I've described as a Swiss Army knife of finance because it gets used in so many different places. In valuation, the cost of capital will become the discount rate I use to get the cash flows. But before we go to that instrument, let me dispense with a question I get asked all the time about cost of equity and cost of debt. I've talked to CFOs again, especially of family group companies in Asia, who claim that equity is cheaper than debt. We kind of talked about this earlier in the class. And their argument is a very simple one. The cost of debt is the interest rate you pay on debt. The cost of equity is the dividends you pay on equity, because that's the only explicit cost of the company. If my dividend yield is lower than my interest rate, equity is cheaper than debt. In fact, if I pay no dividends, my cost of equity is what? 0%. It's absurd, I know. But if I'm the CFO making the argument, tell me again what I'm missing when I claim that the cost of equity is just the dividend yield. I'm not even required to pay a dividend contractually. So what is going to go wrong with my company if all I deliver is a 2% dividend yield to you as an equity investor? What do you need to make as an equity investor to forget about being happy, just to break even? You need the dividend, but you invest in equity. Why? Because you expected some price appreciation, right? When we compute an expected return, the cost of equity, we're not just computing dividends, the expected price appreciation. We tie this to corporate governance. Why? Because if you don't deliver price appreciation, you cannot get sued. It's not a contractual obligation, but your shareholders are going to be pretty pissed off at you. And in a world where corporate governance is strong, they're then going to get you out of the way. They're going to vote for a different board and a different management. So in companies with strong corporate governance, it's going to connect very quickly. Of course, the cost of equity is higher than the cost of debt because we have to deliver price appreciation. But part of the reason we spent those 3 sessions on corporate governance is if you don't have that hook of a strong corporate governance, managers can say, well, what are you going to do to me? They would treat equity as free money. It's exactly what Japanese companies did in the late 1980s when they felt that equity was free, and they would take projects that made 2% to it. It allowed Japanese companies to grow exponentially. But it caught up with them 6, 7, 8 years later because they'd taken projects that they never should have taken with a reasonable cost of equity. The second question is actually a question that you might get asked in an interview. Let's see if you can give me the answer because it's a very tricky question. Can equity ever be cheaper than debt for a company? For 99% of companies, the answer is of course not, right? Because the debt holder is ahead of you in line. If he's charging 10%, you'll charge 12%. There's one exception, though. Anybody want to try to guess what kind of company? Go ahead.
More likely a distressed company that's over-leveraged.
A distressed company that's over-levered, what's going to happen to your beta then? Right? Let's say you have 800% debt. Your beta is going to be through the roof. Your cost of equity is going to be 60, 80, 100%. Right? The guy in front of you is charging 30% to lend to the company. As an equity investor, you have to charge more. Jacob, you want to try?
Um,
I'll give you get you started. The cost of equity is driven by the beta. Beta measures what kind of risk?
feel like negative.
A risk that cannot be diverse. Let's say you're a gold mining company. Remember we talked about one of there are few companies out there which have a lot of risk, but most of the risk is company specific. You can end up with a really low beta. It doesn't even have to be negative because most of your risk is company specific. If you have a really low beta, your cost of equity will be low, but you could have a lot of other risk which a lender is going to bring into the cost of debt. So you could be a gold mining company, the cost of equity that is actually lower than the cost of debt. You think that makes no sense? It makes complete sense because then what should that company do? It should fund itself almost entirely with equity. It should never borrow money. If it borrows money, that doesn't make sense. So can a company so reserve this question for when you come back to interview and you've got this obnoxious person across the table from you. You want because this is the exception. But for most companies, your cost of equity should be higher than the cost of debt. So with that in place, let's talk about why the cost of capital can be used as a vehicle to optimize the debt ratio. The value of a firm can be written as the present value of the cash flows to the entire firm discounted back at the cost of capital. That's just the value. That's plain intrinsic valuation. Let's assume I can keep the cash flows fixed and lower my cost of capital. Go along with me. What's going to happen to my present value? Same cash flows, lower discount rate, my value goes up. And at the limit, if I minimize my cost of capital, what have I done to my value? I've maximized my value. If I can minimize my cost of capital, I've essentially maximized value. And that's my end game, my objective in corporate finance. That is my optimal debt ratio, the one that minimizes cost of capital. So I'm going to pull up an example that is 45 years old. It was from my first corporate finance class. I was an MBA student at UCLA in corporate finance class, and the professor came in with an example of how to optimize debt ratio. He started off with an example of XYZ widget company, which already made me a little suspicious. Because who talks about widget companies when you got 48,000 real companies out there? The advantage of widgets, you don't know whether they're discretionary, non-discretionary, high beta, low, you can make up the numbers. He said, today we're going to talk about how to optimize debt ratio. So he said, XYZ widget company has $200 million in cash flows growing at 3% a year forever. Cash flows are given. And then he said, I have a table here of what will happen to your cost of capital as your debt ratio goes from 0% debt to 100% debt. Already there's one debt ratio there that can't even be viable. You cannot have a company that's all debt. Why? Because somebody's got to bear the residual risk, right? I mean, you can be 99.9% debt. So, but this we're willing to concede 100%, you've rounded up, 0 to 100% debt. And he said, we're going to talk about what's going to happen to the cost of equity and the cost of debt as your debt ratio changes. So first he said, as your debt ratio changes, your cost of equity should go up. And he gave a story. He said equity should get riskier. And it made sense intuitively. Your equity is a residual claim. If I borrow money, I have interest expenses to pay. So what's left becomes more volatile. But some person in the front row, not me, put up his hand. He said, but why is it going up the way it is? Because to be quite honest, it looked like he'd made up the numbers. Right? First 0.5%, 0.6%, points. Basically, it looked, so you could see it going up. He said, don't worry about how it's going up. It's the principle that matters. We let it pass. Then he went to the cost of debt. And he said, as you borrow more money, you will have more default risk. The cost of debt will go up. Again, same guy in the front row put up his hand and said, but why is it going up the way it is? And he said, it's just the principle. Don't worry about the mechanics. And then, of course, he took the cost of capital as a weighted average, and he said, can everybody see what the optimal debt ratio is? The cost of capital is minimized, because when the cost of capital is minimized with the same cash flows and growth rate, my firm value is maximized. He didn't, he didn't understand why we weren't convinced. The mechanics are pretty obvious, right? Cost of capital goes down, value goes up, lowest cost. What we were not convinced about was, why is the cost of equity? How do you come up with the cost of equity at all of these different debt ratios? Because in practice, all you have is the cost of equity and the cost of debt at today's debt ratio, right? That's all you have. Everything else in this table looked made up. I remember coming out of the class saying, I want to figure out a way to get the cost of equity and the cost of debt different debt ratios, because otherwise this is useless. There's nothing I can do with a real company. And that is part of why we've approached estimating cost of equity and cost of debt the way we have. Because what I'm going to do is use that approach to come up with the cost of equity and the cost of debt at different debt ratios. In fact, we gave this guy such a hard time that he decided we were just dim-witted. So he said, you don't get this? Let me show it to you as a graph. And he said, now do you get it? The cost of capital is the lowest point on the graph. Of course it is. Cost of capital is minimized, firm value is maximized. That was not what we were contesting. The question is, how would you get a table like this for a Disney or an Adobe or any other company you're faced with? So I'm going to go back to my Disney cost of capital and try to compute the cost of capital at different debt ratios. Just to remind you of what that original cost of capital was, this is where Disney is right now in November of 2013. Risk-free rate was 2.75%. It's bottom-up beta. I know it's been a long time. Based on the 5 businesses it was in, taking a weighted average, bottom-up levered beta is 1.00. Equity risk premium is 5.76%. That's a weighted average premium based on the parts of the world they operate in. Cost of equity of 8.52%. The cost of debt I got by looking at Disney's actual rating. Because of its single A rating, their default spread is 1%, so cost of debt is 3.75%. Disney's marginal tax rate was 36%. Remember, this is pre-2017, so tax rates in the US were much higher. Cost of debt of 2.4%. Weights were market value weights. Market value of equity, share price times number of shares. Market value of debt included interest-bearing debt and lease commitments put together. 88% equity, 12% debt, cost of capital is 7.81%. That's the one point I know. I need to take this one point and make it look like that XYZ widget table. So let's take the easier half of this equation, which is the cost of equity. To get the cost of equity at every debt ratio, here's what I'm going to do. I'm going to go back to my unlevered beta, which I already have, right? Because I've broken it down, bottom-up beta. And look at what will happen to that beta at every debt ratio from 0 to 90%. So it's 11 beta formula. Basically, I get the levered beta. As my debt ratio goes up, my levered beta will go up. My levered beta goes up, my cost of equity will go up. Risk-free rate and equity risk premium don't change. It's the same companies, same geographies. None of that stuff changes. For the cost of debt, when I first did this, I tried to be lazy. Doesn't take a lot of trying for me to be lazy. It comes naturally to me. Well, how did I get the cost of debt at the existing debt ratio? A single A rating, right, that I got from S&P. I actually faxed at that time. I faxed a page to a student of mine who worked at S&P and said, look, I'm trying to get a cost of debt for Disney at different debt ratios. This was in 1996 when I first did it. And I said, I have the rating of their existing debt ratio. Could you fill out what S&P will give us ratings at all of these other debt ratios? You know what the response I got was? Do it and then we'll tell you. I said, I'm not Disney. I can't go around changing the debt ratio. But the problem is you're not going to be able to get an actual debt ratio to all of those other ratings. But there's a way around that, right? When you have a company that doesn't have a rating, how do we come up with the cost of debt? What did we use to come up with the cost of debt when a company did not have a rating? Sorry? We used the interest coverage ratio. And we went to that lookup table and did a synthetic rating, right? You open the door now. I'm going to walk through. As I borrow money, what's going to happen to my interest coverage ratio as I borrow more money? My interest expense is going to go up. My coverage ratio is going to decrease. I'm going to go to the table. My rating is going to be lower as I go from 20, 30, 40, 50% debt. I'm going to get a synthetic rating at every debt ratio. That synthetic rating obviously is going to be lower with higher debt ratios. My cost of debt is going to go up. That's the opening I'm going to use to get the cost of debt at every debt ratio. I'm going to make sure I have enough income to cover the tax, the interest expense to get the tax benefit. I now will have a cost of debt at every debt ratio. Cost of equity from the levered beta, cost of debt from the synthetic ratings. I'm going to take a weighted average, and I'm going to end up with a table that's going to look just like the XYZ widget company table. But now if you point to a number in the table, I won't say it's just the principle, take it. I'll tell you this is how we got where we are. So let's start. Yeah, go ahead. Yeah, this one. Okay, so okay. So let's say I have a business, right? And you're my equity investor, right? What are the earnings you get? Whatever earnings are left over after interest expenses, right? As I borrow more money, your income becomes more volatile because you have to cover the interest expense first, which is a fixed cost. It's the business is not changing, but the equity in the business can become very risky. This is why real estate as a business is a safe business. You know what makes it risky? The 80, 85, 90% that you borrow makes your equity slice much more volatile. So businesses don't become riskier. The unlevered beta stays the same, but the levered beta captures the effect of debt on your equity. So because we need an unlevered beta, I'm going to review how we got the unlevered beta. One was to stay with the regression beta and unlevered. Remember, we use the average debt to equity ratio. I don't like that approach because it starts with the regression beta. You're saying, what's wrong with the regression beta? Everything. It's backward looking, it's noisy. So that's why we did the alternative, which is to break Disney down by business. So this is not a new table. This is the table we used way back 200 pages ago. We broke it down by business, got an unlevered beta for each business. We came up with an unlevered beta for Disney's operating businesses of 0.9239. Cost of capital is an operating business discount rate. So don't bring in cash, don't even look at cash for the moment, just focus on the operating businesses. That 0.9239 is basically what I'm going to use as my unlevered beta. So I already have the cost of capital at 1 debt ratio, right? When I have 0 debt, what's my beta? 0.9239. My cost of equity will come from that beta. There's no debt. That will then become my cost of capital. So at every debt ratio, I'm going to try to compute. For the interest coverage ratio, I need an operating income. So let me lay the foundations for that as well. In the most recent year, which was 2012 for Disney, this is what the numbers look like. Their operating income was about 9.45 billion, but that was before you adjusted for leases. Remember, this was pre-2019. The operating income adjusted for leases is 10.03 billion. Hold on to that number because you're going to see that number show up over and over again when I do the interest coverage ratio because that's going to be in the numerator. So I know the unlevered beta, I know the operating income. Already you can see for your company, this is going to be something you will have at the time you enter this assessment of what the right mix is, an unlevered beta for your company and the operating income for your company. So let's do the cost of equity part. As I said, this is the easier half because it's purely mechanical. There's my debt to cap ratio, 0 to 90%. I'm going to stop at 90 because going to 99, 95 seems absurd. 90%, that's a lot of debt. That's higher than the debt ratio in a typical LBO. As I go from 0 to 90% debt, my debt to equity ratio climbs more than proportionately. I did this before the first quiz, but if you give me the debt to cap, getting to a debt to equity becomes very simple, right? A debt to cap ratio of 40% means you have $40 of debt, $60 of equity. 40 divided by 60 gives me a debt to equity ratio of 66.67%. A debt to cap ratio of 90% means you have $90 of debt, $10 of equity. 90 divided by 10 gives me 900%. My debt to equity ratio climbs more than proportionately. My unlevered beta stays the same, but as I go through each debt ratio, that levered beta will now have the effect of bringing in the additional risk I've created for my equity investor by borrowing money. You're saying Disney with a beta of 6.24? If you decide to do a leverage buyout of Disney, not a good idea. The day after the leverage buyout, you're going to feel an immense amount of risk as an equity investor, and you should, right? Because you've been taken on this immense amount of debt that you've got to pay off and the interest expenses. Your equity becomes riskier, not because your business is riskier, but because you've taken that risk and magnified it by how much debt you chose to have. Get that levered beta, your cost of equity, because the risk-free rate and the risk premium stay the same. It's just is also going to go up. At a 90% debt ratio, my cost of equity is 39%. So let's say a CFO tells you, my objective is to minimize my cost of equity. What's the only mix that's going to minimize your cost of equity? Not the cost of capital, but the cost of equity. 0% debt. If your end game is you want the lowest possible cost of equity, you've saved me a host of trouble because you should not borrow money. Because the minute you borrow money, your cost of equity will start to rise because that additional risk will make your equity riskier. Now let's talk about the cost of debt. I'm going to take you through my cost of debt calculation for one debt ratio at 10%. And then we're going to do it together at a 20% debt ratio so you can see the process play out. Because I'm going to give you an Excel spreadsheet that does all of the debt ratios, but I want you to be able to do it by hand if you needed to. So you could see every step work out. So at a 0% debt ratio, of course, the company has no debt. EBITDA, depreciation, EBIT are basically out of the income statement. So the question I'm going to ask is, if I go from no debt to 10% debt, what's going to happen to my cost of debt? So I'm going to take you through the steps. And as I go through the steps, there's one step that is, I think, problematic. I want you to tell me which step is going to be the problematic one. So as I go from 0% to 10% debt, the first thing I need to do is compute how much debt I will have in dollar terms. To compute the dollar debt, I actually start with the existing market value of the firm, which I know. Market value of equity plus market value of debt, 137.84 billion. 10% of that number is 13,784. That's step one. I've got the dollar debt. The EBITDA, the DAR, and the EBIT remain exactly the same. It's the same company. I multiply the dollar debt by an interest rate to get the interest expense. That's step two. I divide the operating income by the interest expense. I come up with an interest coverage ratio of 23.1. Remember that lookup table? 23.1 puts me way above 8.5, which is a high. So I will give them a AAA rating and a pre-tax cost of debt of 3.15%. Let me list the 5 steps, and you tell me which one's the problematic one. I start by getting a dollar debt. I multiply the dollar debt by an interest rate to get the interest expense. I divide the operating income by the interest expense to come up with an interest coverage ratio. I use the interest coverage ratio to come up with a rating, and I use the rating to come up with an interest rate. Kelly, help me out. Which step in that process is problem? The first one, the dollar debt I can get, right? Because I get the value of the firm. It's true, I'm using the existing firm value. But to get the interest expense, what did I do? I multiplied the dollar debt by an interest rate. But I don't even know the interest rate yet, right? Because I need the interest expense to get the interest rate. And when you try this first on an Excel spreadsheet, the spreadsheet will go crazy on you. It'll go crazy on you because it's the circular reasoning, right? It is circular reasoning because to get the interest expense, I need the interest expense to get the interest rate to get the interest expense. Let's say you didn't have a spreadsheet. You were doing this by hand. Right? Here's what you do. You'd start with the previous levels. Cost of debt, which in the case of zero debt is AAA. So start with 3.15% as your interest rate. Compute an interest expense. And in this case, you got lucky. Why? Because that interest expense gave you an interest rate that matched up. Saying, what if that doesn't happen? We're going to try that. Let's take the 20% debt ratio and work it through. I'm sorry, the 30% debt ratio and work it through. 30% debt, I will have a debt to equity ratio of 42.86%. That's 30 over 70. To get the dollar debt at 30% debt, I will need 41,352 million. That's 30% of the total value of the firm, which was 137,839. That's 41,352. The EBITDA, the DA, and the EBIT remain the same. It's the same company, same project, same assets, nothing changes. I multiply the 41,352 by the interest rate from the previous level of debt because I don't know it yet. I get an interest expense of 1.302 billion. Interest expense of 1.302 billion gives me a interest coverage ratio of 7.7. Go back to the previous page. Interest coverage ratio of 7.7 gives me a AA rating. I give the AA rating and a cost of debt of 3.45%. We have a problem. Do you see what the problem is? The interest rate I've used to come up with the interest expense doesn't match up to what I claim the interest rate will be at that debt ratio. But there's a fix, right? I went back and recomputed the interest expense at the 3.45% rate. My interest expense obviously will go up now. My coverage ratio will decrease, and I very gingerly turn back to the previous page, hoping and praying. What hasn't happened? That I haven't get done. Yeah. When I do this by hand, I've never had to do more than 2 iterations. The Excel spreadsheet is set up to do 1,000 iterations. So it's overkill. It costs it nothing. But effectively, the spreadsheet just does what you'd have done by hand. Is until you get convergence, you got to keep doing this. In this case, I get convergence at a AA rating. I'm done with the 30% debt ratio. If you want to try this out at a 40% debt ratio, it's a great exercise, a good preparation for the third quiz, not the second quiz. So you might not want to do it right now. Pick the 40% debt ratio. Do it by hand. Start with the dollar debt. You get to the interest expense. You say, what do I do? Use the 3.45% because you know that from the 30%. Compute the interest expense, come up with an interest coverage ratio, come up with the rating, come up with the cost of debt. If it doesn't match, repeat the process again. I'm not going to torture you by taking you through 40, 50, 60, but this is what it looked like when I was done iterating. So this is the dollar debt at every debt ratio. As I go from 0 to 90%, dollar debt grows proportionately. It's always 10%, 20% of that original value. Okay? And as Kelly pointed out, that might be an issue because the original value itself is shifting, but I need to hold at least something stable, otherwise the whole thing starts to kind of go into circular logic itself. The interest expense will always rise more than proportionately. Why? Because as I go to more debt, my interest rate is going up. So as I go from 10, 20, so my interest expense goes from no interest at no debt to $16.4 billion in interest expense at 90% debt. My interest coverage ratio, as my interest expense goes up, remember my EBIT stays the same, drops from 23 down to 0.61. By the time you get to 80, 90% debt, my interest expense is actually higher than my operating income. My interest coverage. I'm a basket case company, and why should I be surprised? I've borrowed immense amounts of money. But there's one more thing I'm going to do. The pre-tax, once I get the synthetic rating, which obviously is going to decrease as the coverage ratio drops and the cost of debt, I'm also going to compute the marginal tax rate I'm going to apply on that interest expense. It's a marginal tax rate, right? Shouldn't change. And in fact, until you get to about 60%, you see the tax rate stays at 36%. Saying, why at 70% is my... First, is this a good thing or a bad thing from a cost to debt perspective to have a lower tax rate? It's a bad thing because it pushes on my... I am losing tax benefits. And the question is, what's happening? Well, if you look at my interest expense, as I go from 60 to 70 to 80%, my interest expense is actually now starting to get to be higher than my operating income. And I'm saying, stop, you can't deduct more than your operating income. I can't claim the extra tax benefit. Now, you might wonder how I come up with this 32.6, 26.8. So I'm going to take you through the 70% debt ratio so you can see how the tax rate is affected. So up to 60%, I have no problems. My interest expense is less than my operating income. I claim the full tax benefit. I get to 70% debt. My interest expense becomes 11.096 billion, higher than my 10,032. And the most I can deduct is the 10,032. That's, the entire operating income. I get the full tax benefit up to 10,032 at 36.1%. That's 3,622 million in tax benefit. My interest expense though is 11,096. So effectively that 10,032 becomes my cap on how much I can deduct. And if my interest expense keeps going up above that, there's no more tax benefit. So the effective tax rate I apply on that cost of debt will decrease. The effect will be to push up your after tax cost of debt even more at those high debt ratios. You see what I'm trying to do, right? I don't want you to end up at a 97% debt ratio as your optimal, because no sane company can pull that off. So I'm trying to pull you away from the cliff saying, don't go too close to that because your tax benefits will be gone, your rating will be in the toilet, your cost of debt is going to be sky high, and I'm trying to bring that all into the cost of capital. So cost of equity goes up because the beta goes up. The cost of debt will go up because the rating decreases and your tax benefits will be gone. I think I can pull the numbers now into a table that looks very much like the XYZ widget company. So this is Disney's cost to capital schedule. When your debt ratio goes from 0 to 90%, the beta goes up, your cost of equity goes up. The after-tax cost of debt increases because the rating drops and the tax rate is adjusted. In the last column, you see the cost of capital at each of the debt ratios. What's my end game again? I want to minimize my cost of capital, right? Right now, they're at 12% debt with a 7.81% cost of capital, but to the extent that I trust the stable, it looks like the cost of capital will keep dropping until they get to about 40% debt, where it's minimized, and then it starts rising again. But by now you can see the dynamics that cause it to rise. At some point in time, that implosion you're creating in your cost of equity and cost of debt start to push your cost of capital up. So while you continue to replace more expensive equity with cheaper debt, your cost of capital goes up. The optimal debt ratio, if your end game is to minimize cost of capital, is a 40% debt ratio, which leaves unanswered the question, why would Disney then stay at 12%? We come back and talk about why companies, rational companies, might choose not to go all the way up to the optimal. There are good reasons and bad reasons for doing it. But clearly, Disney, at least in November of 2013, if you look at their actual and their optimal, has excess debt capacity. Any questions on the mechanics? So try it out by hand with the different debt ratio. If you can do it with your own company, even better. And I'll send you the Excel spreadsheet that'll do the optimal debt ratio for you, but don't make it a black box. Don't say the capital structure spreadsheet told me the optimal was 40%. All it's doing is doing what we did by hand. So it cleans up the process, does the iteration so that you don't have to go through 2 or 3 steps. But if you had to do this with a pencil and a paper, you could actually do this with a calculator. It's not a big deal. It might take you a couple of hours instead of the 2 minutes that spreadsheet does, but you're effectively computing the cost of capital at every debt ratio. Yes. Yeah.
How often do you think CFOs should recalculate the optimal cost of capital?
Okay.
How do you think they should?
So which direction do you think the debt ratio will change? Let's say the risk-free rate goes up. Will my debt ratio, optimal debt ratio, decrease, increase, or give me a sense of direction?
Just want to understand what's the optimal.
Yeah, but I'm saying there are only two inputs here, right? Cost of equity and cost of debt. So when my risk-free rate goes up, what happens to my cost of equity? It'll go up. What happens to my cost of debt? It'll also go up. By itself, interest rates have very little effect on optimal mixes. What will affect, we'll talk about the other things that come in. The level of rates, and that's why when people talked about, hey, companies should borrow more money at 2% rates, why aren't they borrowing it? Because both the cost of equity and the cost of debt come, it's like a rising tide or a falling tide. Interest rates by themselves are not altering your mix. You know what will really alter your mix? What drives your interest coverage ratio? What you have is operating income. If you think a recession is coming or a downturn or a disruption that will cause that number to collapse, that will change your optimal debt ratio. So if you have a shock to your business, you definitely should revisit your optimal debt ratio. But the macro effects on your debt ratio are relatively minor. The micro effects are what you have to worry about as a company. And that, and obviously, hopefully your operating income is not changing every day, every week. It's it should be infrequent enough that you don't have to do. But you have to do this at least at regular intervals because things do change. in the external environment. So I did my own version of that XYZ widget company. It's not quite U-shaped, right? It's a very, very shallow V. So there's, and in fact, once you get to the optimal, notice how what happens to the cost of capital? It starts to climb very quickly. Now do you see why you might not want to go all the way to your optimal? Because there's a tipping point where if you hit that tipping point, you very quickly spiral in. So if you're going to make a mistake on financial leverage, on debt ratios, it's better to be under levered than over levered. It's better to stay, but it's good to know what your optimal is. Doesn't mean you should know the optimal. But if Disney said, should we be at 30 or 50? I would say it's better for you to stay at 30 because the mistake you're making, it's a slightly higher cost of capital than the optimal. But I'd rather you kind of hold back on pushing all the way to the optimal than pushing through it and ending up with the spiral, the debt spiral on ratings and cost of debt that cause your cost of capital to explode. The first edition of this book came out in 1998, the Applied Corporate Finance book. And that's the first time I did the optimal debt ratio for Disney. And that time I graphed it out just like I did. And that Excel spreadsheet that you're going to get is in earlier versions, been around for more than 25 years on my webpage. And people download it, they use it. I really don't care. No. But I remember I was sitting in my office and a First Chicago banker, this is how long ago this was. First Chicago is no longer in existence because it was bought by Chase and Chase became part of JP Morgan. I knew they were downloading the spreadsheet, using it to come up with optimal mixes and presenting their clients as First Chicago analysis. Okay. I said, okay, that's fine. And I don't need a piece of the, because I don't want to have any part of what you're telling them to do. So I'm sitting in my office and I get a call from a First Chicago banker. He says, I'm calling from a restroom. So why the hell are you calling me from a restroom? He says, something very embarrassing has happened. You should call your mother. He said, no, no, not that kind of embarrassing. I'm in the middle of a client presentation where I'm coming up with the optimal debt ratio. I've used your spreadsheet and I put up this graph and there's a kink in the cost of capital. Why? It takes a lot of gumption to download a spreadsheet of somebody's webpage, use it for commercial purposes, and then turn around and say, why? And, so he is talking about, you can see the kink in 97, right? You see it goes up. Can you tell me what it is about the way we're computing cost of capital at different debt ratios that might create the kink? Because I told him, but you could probably have told him as well. What are the two numbers that drive my cost of capital? Cost of equity, cost of debt. It has to be one of those things moving discontinuously. Cost of equity moves continuously, right? Every time my debt ratio changes, my cost of equity changes. But when does my cost of debt change? Is when my interest coverage ratio changes enough for me to slip down the ratings table, right? So if I borrow more money and my interest coverage ratio leaves me in the same segment of the interest coverage ratio, I give you the same cost of debt. In the real world, that wouldn't happen. You can be a double B rated company, but you can have a higher interest rate than another double B rated company because you have more debt. So I went through it and said, look, that's what's happening. I'm using an interest coverage ratio table. The rating is discontinuous, and that can cause this to happen. He said, how do I make it go away? So I told him, I said, there are two things you can do. The first is that table that I've created for the synthetic ratings is completely my table, right? I can make it double A plus plus. I can start to split the table up into finer and finer. No, so it'll be 50 line items then. And you can come up, and if you do that, then you're less likely to be stuck in that same segment. He said, that sounds like a lot of work. I said, okay. So I gave him a second suggestion. I said, how strong is your statistics? He said, I barely remember. And I said, well, then you're probably in trouble, because the second thing you can do is the only reason I need a rating is to get a cost of debt, right? What if I could take the interest coverage ratio and directly connect it to the cost of debt? In other words, forget about the rating. That'll require, some process very much like a levered beta process, Where if you tell me what your interest coverage ratio is, this is what the interest rate should be. He said, that is too complicated. I said, tell me again where the kink in your cost to capital is. Is it right at your optimal? He said, no, it's around this. It's like in this table, where? And I said, then why does it matter? Your optimal debt ratio is your optimal debt ratio. If you can explain that why there's a kink, why does it matter that there, other than for cosmetic reasons? I've never felt the urge to smooth out the kink, but if you do find a kink in your cost to capital, it's because of that part of the process, that discontinuous cost of debt, where the ratings are not changing continuously as the debt ratio changes. The optimal is the optimal. It's still 40%. And why is it the optimal? Because my cost of capital is lower at that debt ratio than at every other debt ratio. So let's convert this percentage optimal into dollar values, because you're probably going to find the number a little shocking when I convert to dollar value. At a 40% debt ratio, Disney will need to have about $55 billion in debt. Disney right now has about 16 billion in debt. So if you were advising Disney, what are you advising them to do? Go out and borrow 39 billion. Here's the part that I left out. As I went from 0% to 10% to 20% to 30% debt, remember my EBITDA, my DA, and my EBIT stayed exactly the same. You see, where's all this money going? Because if you're raising, at each stage, 13, $14 billion, you know what I'm doing? I'm taking that money and I'm using it to bring down my equity by either paying a dividend or buying back stock. It's called a recapitalization. I'm essentially leaving the company's asset side of the balance sheet fixed and changing just the mix of debt and equity. Why? Because I want to isolate the effect of financing mix. If I let Disney take projects with that extra 14 billion in debt, it creates a second factor, right? What's the net present value of the project? I don't want that affecting my financing mix. Whenever you optimize debt ratios, you have to do it. You have to hold the business fixed and change just the mix of debt and equity. So here's the advice I'm giving Disney, and you're going to see very quickly why they're going to be a little hesitant to run with it. I want Disney to go out and borrow $39 billion and buy back stock. That's a big deal, right? So if Disney's management has any sense, there should be three questions they should ask. If any management, if you tell them to go out and borrow a huge amount of debt and buy back stock, the first question should be, why should we do it? What do we gain by going out and borrowing 39? You're saying it's obvious your cost of capital will be lower, 7.16%. That doesn't quite have the heft, right? Because you want me to borrow $39 billion to reduce my cost of capital by 65 basis points, 0.65%. It sounds like I'm doing too much to get too little. I've got to convert that 0.65% cost of capital into real money. Why should we do it? Second, what if something goes wrong? Like what? What if there is a recession? What if the theme park has to shut down? What if there's a pandemic? Good question to ask anytime you borrow money. What if something goes wrong? And third, what if we don't want to buy back stock? We have all these plans to grow as a company. It seems silly to borrow the money and buy back stock when we have to raise money to build more theme parks and movies. Can we use the debt that you claim, the debt capacity you claim we have, to take projects instead of buying back stock? Legitimate questions, right? Why should we do it? What if something goes wrong? And can we use this debt capacity to do an acquisition, to take projects? So let's take each of those questions, and the answers I'm going to come up with Disney are generic approach, based on generic approaches that you can apply in any company. Let's start with the first one. Why should we do it? Lower cost of capital, right? But why does the lower cost of capital help? Because it increases my value as a firm. So let's first figure out how much Disney's value as a firm will increase if they go to their optimum. Right now, so I computed the cash flow to Disney as a company. It's a little ahead of the game because we'll get to this later in valuation, but this is how we computed the cash flows for projects. You start with the operating income, you add back depreciation, subtract capex, subtract change in working capital, 3.657 billion. Their existing value, If you take their existing enterprise value, market value of equity plus debt minus cash, 133.9 billion. So the first thing I did was I said, let's assume the market is valuing the company correctly. Because this stage, I want to focus on financing mix. Given the cash flows and their existing cost of capital, what is the growth rate that the market is assuming Disney will be able to have? So this is pure algebra. 133.9 billion is my value, 3.657 billion is the cash flow, 7.81% is their existing cost of capital. Based on what the market seems to be valuing the company at, if you back out the growth rate, you come up with a 4.94% growth rate. That growth rate troubles me, and I'll tell you in a minute why it is troubling. But the pure math gives me that. That's called an implied growth rate. I'm backing it out of the market and saying this is what the market is building in. So tomorrow, let's say Disney goes out, changes its debt ratio to 40%. Take a look at this equation. 3,657 is a pre-debt cash flow. That doesn't change. The growth rate of 4.94% is in that cash flow. That doesn't change. The only thing that changes is the cost of capital, which goes from 7.81 to 7.16%. You revalue Disney with the lower cost of capital. The value that you get is 172.9 billion. This is like magic, right? Same company, same project, same business. All I did was change the debt ratio, and I've increased the value by 39 billion. How the heck do you create I mean, this is like what the LBO guys said. We've created value, 39 billion value. I think I've overstated the value increase, and I'll talk in a minute about why when I do this I've done. But you can see the effect on value comes from having a lower cost of capital. The flaw in this approach is that 4.94% growth rate. That growth rate, I'm assuming, is a growth rate you can maintain forever. And I don't think you can pull that off. In a risk-free rate of 2.75%, this is too high a growth rate to sustain forever. So I'm going to give you a shortcut that I prefer when I look at change in value from cost of capital. One way to think about the cost of capital is it's what it's costing you to fund the company today. So if you look at the cost of capital of 7.81% they have right now, and the value of the firm, the current market value of the firm, right now at their existing cost of capital, it's costing them about 10.46 billion a year to fund the firm. After they change their debt ratio, they're going to have a 7.16% cost of capital, which means the cost of funding this firm has gone from 10.46 to 9.6 billion. Every year, I'm saving about $866 million. You can take that saving each year and look at the present value of that savings. And here I can put a cap on that savings of, I'm not going to let it grow at a rate faster than the risk-free rate. And we'll talk about why the risk-free rate is a good proxy for that long-term growth. 8.866 million growing at 2.75% a year in perpetuity with a 7.16% cost of capital increases my value by 19.6 billion. If Disney goes to its optimal, I'm not going to talk about the cost of capital dropping by 65 basis points. That's not going to be effective. You're going to increase your value as a company by 19.6 billion. But it still feels like magic, right? Where is this increase in value coming from? It's the same theme parks, same movies. Where is this increase in value coming from? It's like the laws of physics. You can't create something out of nothing. It has to come from someone, somewhere. Where is this 19.6 billion value coming from? I know it's coming from a lower cost of capital, right? But why is my cost of capital lower at a 40% debt ratio? Because it's true, debt is cheaper, and the debt is cheaper because of a tax saving. If I make the tax rate 0%, you know what the optimal debt ratio here will be? 0% debt. This entire increase in value is not coming from better project, great investments. It's a transfer of wealth. And I'm not going to, it's not a moral statement that I'm going to make. It's a transfer of wealth to Disney from whom? Taxpayers. Right? So the next time an LBO guy gets up and boasts about how much value they've created, you got to stop them and say, you're not creating value, you're moving value around. In fact, if the only thing you're seeing in an economy is recapitalizations and leverage transaction, the economy is not getting better off, right? All you're doing is shifting value. Again, I'm not, it's entirely, it's not an ethical statement. The tax law is what it is. You didn't write the tax law, you're taking advantage of it. But don't go around telling people you're creating value by taking, this is not about taking better projects, building more theme parks, making better movies. It's about using the tax law to essentially transfer wealth legally from taxpayers to yourself. That's where the entire increase in value comes from, is that tax. So that's why if you go to the spreadsheet and make your tax rate 0%, that entire value increase will disappear. So why should we do it? First step is lower cost of capital. Then you convert that lower cost of capital into value, you can see that effect play out. Now, of course, there's a practical question. To do this, I need to go out and buy back stock, right? And the question is, what price should I pay to buy the stock back at? This is going to be a big buyback. You can't just slip into the market, do a little at a time. You got to do what's the equivalent of a tender offer, what you see in acquisition. So Disney has to take a full page ad saying, if you're a Disney shareholder, you can put your shares back to us and we will pay you X dollars. Let me set the stage. The stock price at the time of this transaction, of this analysis, was $67.71. I want you to play the role of Disney shareholders. You're all shareholders in Disney. You own the shares now at 67.71. I'm planning to do this major buyback, and I'm going to make a tender offer for the shares. Can I make a tender offer at 67.71? I could, but nobody will submit the shares, right? So almost by definition, I have to offer a premium. If you let your bankers determine that premium, what are they going to do? Offer a huge premium because it makes their job easier. The larger the premium, the easier the buyback goes. But remember, when you pay that premium, you're essentially, that cash is leaving the company. And you want to be fair because there are two groups of people here. One is the shareholders who will sell their shares back, so you guys can be those shareholders, and the shareholders who will stay with the company. If this were a fair universe, and I know it's not, that $19.6 billion in firm value, everybody should get an equal share of it, right? The people who sell back, the people who remain. I'm going to call that my rational solution. I'm using the word rational with quotes around it. If this were a rational universe where companies paid fair value, then I would pay the same, the price that I pay on my buyback should be roughly equal to the price left for the shareholders behind. It actually makes my life easier because what it means is I can take the increase in firm value and divide by the total number of shares outstanding. Even though I know that share count is going to drop, that gives me an extra 1090. If you add the 1090 on, I can offer $78.61 on my buyback. And if I can pull it off at that price, here's what will happen. The people who sell their shares back will get 1090 a share. The people who are remaining in the company will also get 1090 a share. You'll be indifferent between selling back and not selling back. The only reason you might sell back is why? If you're getting the same amount, why might some people sell back and others not sell back? One is if you do sell back, there's a tax consequence, right? You got to pay capital gains, and if you need the cash, you're saying, I don't care. But if you don't want to bear that tax consequence, you don't need the cash, and you don't sell back, you get the same increase in value, but there's no tax attached because you haven't sold the shares. That's a pure tax choice, but you're giving people that choice. This is the rational solution because effectively everybody gets an equal share. It almost never happens. In the real world, companies either pay too much on buybacks or pay too little. Which mistake do you think is more common? Pay too much on buybacks or pay too little? They pay too much because bankers you hire a banker to get it makes their life easier to set the price too high. And if you don't have a reservation price, which is what we have here, you're going to keep pushing the price up until you can sell the shares. So here's the more general solution of what happens when you buy back shares. First, start with the increase in debt you have. So the case of Disney, that's the $39 billion in debt. The shares you will buy back will be based upon the share price you pay on the buyback. So it'll be the increase in debt divided by the price you pay on the buyback. So you could pay 79.61, you could pay 84, you could pay 90, you could pay 95. The higher the price, the fewer the shares you will buy back with that same dollar debt. Compute the shares left over after the buyback, and that share will be the shares before minus the shares you bought back. Then take the value of the firm after you do the buyback and divide the equity value by the remaining shares outstanding. What you will then get is two different prices, one for the buyback, one for the remaining shareholders. And those prices can be different. One group is going to get gypped relative to the other one if you don't pay a fair price. So first, let's check that 7861 to see if it works, if it is in fact a fair price. So I took the 39,175 million additional debt, divide by, so this is actually, let me do the 7861 first. Divide by the 7861. Remember that was the rational price? I'll have 1,301.65 million shares outstanding after the buyback at the rational price. If you look at the enterprise value, at that optimal debt ratio, the enterprise value is 153.53 billion. That's a 19.6 billion added on. Plus cash minus debt, there's the equity value, 102 billion. You divide the equity value by the shares outstanding, here's the magic. You get exactly the same price. This is a fair world because everybody gets exactly the same increase in value. That's why it's rational. Is it possible that Disney could have bought the shares back at the 67.71? Could be, right? I remember the Bass brothers used to be big shareholders in Disney, and they were these Texas-based billionaires. They had a bad deal gone. They needed cash in a hurry. Let's suppose you have a large shareholder in your company, in Disney, who needs cash in a hurry. It's entirely possible they'll take the 67.71. So if I'd paid 67.71, so the people who sell the shares back are selling for 67.70, you can already see who's going to benefit, right? You as the remaining shareholders are going to get the entire increase in value for yourself. And here's how it plays out. I'll be buying back more shares because I paid a lower price. If I take the equity value and divide by the share count now, the value for the remaining shares will be 83.78. So you got 67.71, they got 83.78. It's not fair, but you sold the shares back. Nobody put a gun to your head and said you got to. So already you can see you can play with different buyback prices. Try this out when you get a chance. Put in a $90 buyback price. The banker got crazy, offered $90. Play the game out. You can already see that at a $90 share price, you're going to end up with a much lower stock price. In fact, there is a price I can pay on the buybacks where you will actually end up with a price per share less than 67.71 if I overpay enough. There's only 19.6 billion. It's spoils to go around. So if I keep upping the price and I don't watch out, there will be a tipping point where I will be paying 19.6 billion plus to the people who sell back their shares. And that's why when I write about buybacks, again, it's very difficult to make a generic statement. Are they good? They're bad. Buybacks don't create value. They can transfer wealth from the shareholders who don't buy back to the shareholders who buy back, or the reverse, depending on what the buyback price is. So when you do the optimal, you can come up with that extra dollar debt, then you can work through, will that make sense? Any questions on this process of working through what will happen to your stock price at different numbers? Right? Which brings us to the second question. What if something goes wrong? If you're ever on the consulting or the banking side of this pitch where you're telling companies they have excess debt capacity, and then somebody in the management says, what if something goes wrong? Here's the one answer you should never give. Nothing will go wrong. It's almost like you're tempting the fates while you're standing there, because before you even leave the room, something will go wrong. So when managers say, what if something goes wrong? Turn the question back on them. Say, tell me what the things you worry about most are. Because let's face it, they're more immersed in their business than you and I ever will be. So telling them nothing will go wrong is both unrealistic, and it really doesn't reflect the knowledge of the business you need for that. So if you're a defense contractor, what is the thing that could go wrong that could alter your value? could lose that contract, which is 60% of your revenues. You're a manufacturer, you get 35% of your revenues from Walmart, they're your biggest customer. That could, if you're a cyclical company, it could be a recession. If you're a hotel company, it could be a pandemic, right? So it could be different things. And your job then is to say, let's look at what happens to your optimal if that thing unfolds, a recession, a pandemic, loss of contract. So when you do the optimal, that's your first, it's not the end of the game, it's the start of a process. You say, let's check to see how sensitive this optimal is to changes in your operating income. That's a key driver of your optimal debt ratio. So you could do what if another, what if my operating income dropped by 10%, 20%, 30%, looking at history to see what a bad year looks like for you as a company. The second thing you can do is run different scenarios on your operating income. What happens in a recession? What happens in a recovery to see what the optimal will look like under each scenario. You want your company to survive across scenarios, not just in your best case scenario or expected scenario. So one way to ask what if questions is through the operating income and seeing how it plays out. The other is through the rating process. Remember I came up with a synthetic rating for the company at every debt ratio? And then I used to come up with the optimal debt ratio for the firm. I didn't check at the optimal what the rating for the company was. What if the rating was double B? Would that trouble you as a company if I told you to go to a double B rating even if it gave you the lowest cost of capital? What's a magical thing about about ratings? About triple B and ratings. What does that divide? Investment grade from non-investment grade. You're saying who cares? Once you fall below investment grade, things get more difficult. It used to be impossible at one point in time. They get more difficult, raising more capital. It's not just the cost of debt goes up. People start to worry. Remember we talked about indirect bankruptcy costs? That's when those indirect bankruptcy costs. So I think it's legitimate for companies to say, I want the lowest cost of capital subject to a rating constraint, investment grade, or maybe one notch above investment grade because you want to give some buffer. Once in a while, you will get a company that says, I want a AAA rating. No, that's a rating constraint as well. We'll talk about how to separate realistic constraints from unrealistic constraints. So I'm going to end today's class by looking at Disney's history. What am I trying to estimate? What does a bad year for Disney look like? You think, wouldn't it be the same for every company? Their operating income decreases? That's true. For Con Ed, a bad year is a 10% drop in operating income. For Dell, a bad year is a 60% drop in operating income, right? Different businesses, different downsides. You have to look at your own history. And in this case, when you look at the history of Disney going back to 87, there's the worst year Disney's ever had, 2000, down 29.47%. 2009 was pretty bad too, 23%. So already you can see it's going to frame your what if question. You're not going to ask what if operating income drops by 80%. That's not Disney's history. You're going to drop by 10%, maybe 20, 30. I did also look at the last 4 economic recessions leading into, before this was in 2013. And I looked to see how Disney did, and its operating income got a hit, 15, 20. Though in 1981, their operating income actually increased by 12%. That's way back in time. So Disney obviously can have bad years. A bad year for Disney is probably a 20% or a 30% drop in operating income. And all I had to do was go into my Excel spreadsheet, take the 10,000 and 32 million operating income, drop it by 10, 20, 30, to see what would happen to my optimal. You think, it's going to go down. By how much? Let's say if I drop it by 10%, the optimal goes back to 10% debt ratio. I'm going to tell Disney you probably should stay at a 12% debt ratio because a small drop in your operating income will make you over-levered. What I found instead, though, as I dropped my operating income by 10 or 20%, the optimal stayed unchanged till I got to about a 40% drop in operating income, which Disney had never seen in its history. You know what? This is a great tool for dealing with managers who are so inherently conservative that they can see the excess debt capacity, but they're saying, what if something goes wrong? So what do? You take what can go wrong, you put it in and say, you know what, even if your worst case scenario unfolds, you should be at a 20% debt ratio. You're at 5% debt. So go to the 20% if that's what you're comfortable doing. Your job is not to push management to borrow more money, but to get them to borrow enough money that they can run this company comfortably still, make the right decisions without having to worry about the debt components driving their choices. So what if something goes wrong? Let it play out. Next session, when we start off, we'll start with rating constraints, why companies impose rating constraints, and how to bring them in. But I will send you the link to the Excel spreadsheet. For the moment, I know you're going to be working on the second quiz, but if you get a chance, you might want to play with it for your company.